What's up, everybody? We are once again going to talk about Fiserv. As you may know, when this stock was at around 120, I said I thought it looked like value. Now, at the time, we were looking at a stock that was guiding for about $10 in earnings per share, that was guiding for double-digit growth on the top line. This is a company, by the way, that has grown earnings per share by double digits for about 40 years. And today we see the stock is trading in the low 60s. Now, last week, we looked at their Q3 earnings. It was a horrible earnings report, not just a miss, it was an airball, as I said in a comment. They were really nowhere close. The stock obviously deserved to drop. The growth assumptions and margin assumptions I was making previously were definitely overstated. I was assuming 7% growth on the top line in my base case. After this report, we brought those assumptions down a ton last week. But the price of Fiserv continues to basically just slide down. The question is this an opportunity right now, or should we stay away? Was a 50% drop in the stock price warrant it? Right now, this company is trading at a single-digit multiple of earnings, between 7 and 8 times free cash flow. It is dirt cheap. And yes, this chart looks really ugly. The stock is down 70% over a year, and even in the past month, as we just said, basically cut in half. But we can't do anything about the past. When we are looking to buy a stock, what we are concerned about is the future. Looking at the past chart, it only tells us so much. We're going to try to take a step back today, remove ourselves from, any feelings you might have about the price drop, and just ask ourselves, what do we think that this business is worth? As always, if you get value out of the video, subscribe to the channel. If you want to make Google Sheets like this, or if you want early access to a rough version of my website that I am building where you can look up companies like Fiserv as well, then consider following me on Patreon. Link to that will be down below. Now on this channel, of course, we're always diving into the operations of a business. We want to know, how is it that they're making money? What's going on with these segments? Do they have a competitive advantage? We're looking at the fundamentals, but actually, first things first for today, I just want to talk a little bit about psychology and investing philosophy. We are all human, and we cannot escape from the feelings of fear and greed. They drive markets, and especially fear. We respond much more to fear than almost any other emotion. This is a completely different stock, completely different business, but I just want to talk a bit about Meta. I know I've mentioned it before, but it's just such a clear illustration of the power of investor sentiment. By the middle of 2022, their stock price had pretty much been cut in half from the peak in 2021. Free cash flow was way down. Earnings were down. They were investing heavily in the metaverse at the time. Mark Zuckerberg has been an excellent leader of this company, but at the time, there were also serious concerns about governance. He had full control over the business. Because of the different classes of voting shares, then, even though Mark Zuckerberg doesn't own a majority of Meta, he does own the majority of the voting power. If he wanted to dive headfirst, sinking cash into the black hole of the metaverse, there is nothing that anyone could do about it. These are real risks, and these operational risks were there at $350 a share, just like they were there at $160 a share. There are always operational risks. When we're looking at an individual stock, you can always find risk. However, when a stock is at an all-time high, when sentiment is very strong, people don't see risk as clearly, or they brush it aside, or they say this is a quality company. The risk is not here in the same way that it is in, some other name. All of a sudden, at $160 a share, everyone was talking about risk. Analysts downgraded Meta immensely, and I bought. I thought Meta was value. I thought it was still cheap compared to its cash flow potential. It was essentially a duopoly with Google in digital advertising, a space that has a bunch of tailwinds. Like with pretty much every business I look at, I saw risk, but I thought the risk reward at this price, at $160 a share, I thought it was good. And even still, over the next few months, I was cut roughly in half. Meta stock was trading in the 80s. Analysts downgraded Meta much more. There were tons of people who were saying, Facebook is a dying company. Why would you invest in this? Just a year earlier, it was almost $400 a share, and people were not seeing the risk there. Now that it's in the 80s, everyone is seeing risk, and no one is seeing the opportunity. No one is seeing the reward down here. That's how it is a lot of times. But let me tell you, the risk to Meta was much greater in the 300s than it was, under $100 a share. Your risk buying down here under 100s, you're buying a company for a single-digit multiple that still was a market leader, that still was a dominant business, a duopoly, that still had a ton of cash flow potential. This was only 3 years ago. I mean, nowadays you hear people talk about Meta, they talk about how amazing of a company it is. I agree. I still think that Meta is a great business, but let me tell you, value. It is riskier today than it was under $100 a share, but you don't feel that risk. If you were investing at this time and you were looking at Meta a few years ago, just try to remember what was that feeling that you felt in your gut about the risk of Meta and compare that with how you feel today. How do you just instinctually feel about the risk to Meta today? I think if we're being honest with ourselves, most investors were way more scared putting their money in Meta back here than they are investing in Meta today. Obviously, this is a very different business than Fiserv. But my point with all of this is that your instinctual feeling about fear, your instinctual feeling about risk is often not a great measure of what the risk actually is. Whenever there's a huge move in a stock price, whether it's up or down, I always suggest you go and take a walk, maybe drink a tea, do whatever it is for you that helps you relax. You want to have a clear head that is as unaffected as possible by the emotions of fear and greed when we're just looking at a stock and we're trying to decide, is this value? Now, trying to approach this company, Fiserv, with a clear head, what do we think? A huge problem, it's clear, was management and how they were communicating their expectations. The old CEO, CFO, they were guiding for very inflated numbers that they could not meet. They were not being very forthcoming with what was truly going on in their financial solutions segment. Excluding Argentina, this company has had mid-single-digit growth for quite a while, and they were guiding for double digits. Now at Fiserv, it is pretty much an entirely new management team. Yes, you have a new CEO who came in May. I don't think he's blameless. I think he should have known what was going on with the business by the time of their quarter 2 earnings call. But I think he was actually a fairly straight shooter on this quarter 3 call here. And I think it's going to take a while to win back investor trust, but really most of the blame here can't be placed on the new CEO. They fired their CFO. Their new CFO is coming over from Global Payments. They have a new co-president who's coming over from Optum at UNH. They shook up the board quite a bit. So, this is really a completely new management team that has been put in place here. I will also say, I don't know if this is the case here. I hope it is, but it's not something I'm going to rely on. But often when a new management team comes in place, especially a new CEO, when a new CEO comes in, it's often a time to reset expectations. And often new management will set expectations low. They'll give numbers that they believe that they can outperform to just, make themselves look good. And as far as what management is guiding for, this is a company that is still growing. Taking a big bird's eye view of the business, this is still a market leader with very good margins, I should add. Their merchant solutions, which is primarily Clover. Clover is the market leader. They have more gross volume than their peers. Their operating margins are better than most of their peers. I think the segment has some natural tailwinds, and yes, they're still growing. Financial solutions, this quarter was a mess, and some of that can be blamed on Argentina, but it appears whichever way you slice it, growth is slowing here. They have competition, margins are coming down, but still, this is a mostly subscription business. This is not a company that is going anywhere anytime soon, and they are still highly profitable. The revenue tends to be very sticky, they make a ton of cash, and they return quite a bit of that to shareholders. Overall, what is this new management guiding for? Well, they're guiding for revenue growth, top line growth to be about, 3 to 4%. That's a huge step down, and adjusted EPS of, $8.50 roughly. This is also a big drop from what people were expecting. Across the board, these numbers were a big letdown, but right now at current prices, the company is trading for less than 8 times this adjusted EPS number. And in case you're wondering what their adjustment is, they add back in amortization related to their acquisitions. That's pretty standard. They're not doing some nonsense like adding back in share-based compensation. In many ways, I think this number is a fairly close reflection of the underlying earnings power of the business. I don't see a broken company. In fact, I don't even see a company that is stagnating. They are actually still growing here. Yes, growth is slowing. Yes, there is competition. And yes, the previous management completely misguided on these numbers. But do we think a company like this deserves to trade for 7.5 times free cash flow? Maybe, maybe not. But one thing that I can say for sure is this company trading at 7.5 times free cash flow today, investing in this stock is less risky now than it was at $200 some a share just a few months ago. This is a less risky investment today. If you disagree with that, let me know why down in the comments below. I understand it doesn't feel that way. Everyone is downgrading this stock now. Everyone sees all the risk and feels all the fear at moments like this. And now, with all that said, maybe let's just add some numbers to it. At current prices, what do we think is a realistic return on our investment for investing in Fiserv stock? My base case, I'm assuming 4% revenue growth over 5 years. I'm assuming that margins pull back a bit to 28% operating margins. I'm assuming that their free cash flow they return to us shareholders is also going to come down a bit. And by the way, they have been using this free cash flow to buy back a simply massive amount of stock. I hope that's how management is using the cash flow now, to buy back more stock when shares are cheap. It should be mentioned the debt is quite significant in this company. This isn't really a deep dive. If you want that, you can look at my previous videos on Fiserv. The interest they pay on this debt is quite low. I think when you look at the cash flow that the company generates, it's manageable, although yes, I will admit, high. 4.5 times operating income, that's definitely high to me. Now, getting back to our base case assumptions here, I'm only giving them a 13 times multiple. I think that's fair for a company like this. And in this scenario, you're looking at close to a triple on this stock over 5 years. If I bring this multiple back and I just give them an 11 times multiple, you're looking at a 19% annualized return, a gain of 140% over 5 years. In my bear case, how ugly can this get with Fiserv? I'm giving them 1% revenue growth. This is pretty difficult to imagine, and I'm also assuming that margins pull back quite significantly to 25%. Free cash flow also comes back down, and let's give them only a 9 times multiple. And in this scenario, you're still up money after 5 years. Yes, if you had a crystal ball and you knew that this scenario was going to come true and you would have a 3% return every year for 5 years, you wouldn't invest in this stock today, I imagine. But my point here is the risk is relatively low at current prices. As far as the bull case, as far as the upside here, let's assume that revenue grows 4% for the next couple of years, like management says, and then re-accelerates to 7%. These still would be shy of where they've been in the past. And operating margin, I'm not assuming margin expansion. I'm assuming they're able to maintain their margins. I understand that seems optimistic today, but this is my bull case, and I'm giving them an 18 times multiple. Now, I know in moments like these, giving a company a multiple like 18 when it's trading for basically single digits right now seems incredibly optimistic. I just want to bring back the story of Meta. There is a ton that can change over 5 years. The stock was trading at single-digit multiples here in 2022. Now it's trading more like 30 times earnings. In just a few years, sentiment can change massively. I don't think giving this company an 18 times multiple is anything crazy. I want to remind you, this is still a market leader. And in this scenario, you're looking at roughly a 40% annualized return. I mean, this would be a 5x over 5 years. So when I look at this company, yes, there's problems. Yes, there is risk. There is always risk with individual stocks. You can always find risk. My argument is the risk today is actually much lower than I think it feels to many investors. It's certainly much lower than it was at $200 a share, and the risk reward I think is excellent. Now, as always, this is not advice to buy Fiserv stock. I just give you my opinion and I tell you what I'm doing with my money. And on that note, as I said on Discord for Patreon members, the day that I made these purchases, I made my first buy of Fiserv shares at $65 a share. I then bought again on Thursday, a little under $62 a share. I also own very long dated call options. I own the January 2028 $65 strike calls on Fiserv. I normally prefer to just buy equity. I don't often go long on calls. However, I thought I was offered a good price. Now, with all that said, I have no clue what's going to happen to the price of Fiserv stock. Will it continue to drift lower? I don't know. Maybe. We might be heading into the 50s or worse. I have no way of predicting the short-term movement here. But I think we're being offered excellent risk reward today. And if it gets cheaper, I very likely will add to my position. I'm probably not going to make this too large of a position until we hear from management again at the next earnings call. But I simply think at these prices, this business, it's just too cheap. So those are my thoughts about Fiserv. I hope you got value out of the video. If you did, subscribe to the channel. If you agree or disagree with anything I said, leave that down in a comment below. And if you want, consider following me on Patreon. And I hope to see you all in another video.